Hello everyone! As we do every month, we are going to share with you the main insights that can be extracted from our digital top-down methodology. Our method consists of evaluating the attractiveness of European equities with regards to four complementary pillars of analysis. The first pillar focuses on the economic momentum in Europe. The latter, after having reached an all-time high at the end of June, is decelerating while remaining at a high level. The favorable base effects associated with the summer 2020 dip in activity are dissipating. However, the economic recovery will be strong, with the economist consensus forecasting 5% GDP growth in 2021 and 4.3% in 2022 in the Eurozone. This remains an obviously buoyant environment for equities in the medium term and for its most cyclical components, even if the market seems to have gone up a bit quickly. The second pillar relates to the ECB's monetary policy. The ECB is very accommodative, and the spectacular rise in inflation is pushing down real rates and facilitating the spread of a monetary policy that will remain for many months to come, even if the US Fed has recently tightened its stance. Monetary conditions are not without consequences for the third pillar of our analysis, which focus on European market valuations. In a context where interest rates are very low or even negative, the notion of valuation becomes key. The risk premium of European equity markets stands at 6.3%, a generous level compared to the historical average of 5%. A return to this historical average could lead to a re-rating of the European equity market of around 15%. Furthermore, the European earnings growth is on track. Earnings in 2022 are expected to be 20% above their pre-COVID crisis level. In addition, the earnings momentum of the consensus remains strong. Earnings expectations for 2022 were indeed raised by 1.8% in October as quarterly earnings publications started. Finally, the fourth pillar deals with the behavioral aspect. The momentum is bullish insofar as all international equity indices, with the exception of China, are above their 200-day moving average. European indices are now approaching the key level of the historical high of 2000, while seasonality is once again favorable to equities. In conclusion, the environment is broadly favorable for European equities. They remain strategically unavoidable in an asset allocation. The economic momentum remains at a good level despite its recent slowdown. The central banks is flooding the financial system with liquidity, low interest rates justify a deep revaluation, and finally, market dynamics remain bullish, even if the short-term dimension is more neutral after the sharp rise observed since March 2020. Each correction in the indices should be seen in this context as an opportunity to increase exposure to European equities. Thank you, and see you next month for a new monthly video by Shaheen Capital.